Our next speaker is a lady, Ms. Lara Smith. Lara is the Managing Director and founder of Core Consultants, and she will speak about minor metals in Africa. Lara has over 8 years' experience in analyzing commodity markets. She began her career as an equity analyst for Ford Asset Management in Cape Town, and she was then appointed by the Steinmetz Group as the lead resource analyst, where she was responsible for sourcing, analyzing and evaluating potential mining acquisitions in Africa and the Baltic regions. Lara is native to Cape Town, and she has degrees and a sort of bachelor degree in financial valuation and portfolio management from the University of Cape Town. So please welcome Lara Smith.
Good afternoon, ladies and gentlemen. It's wonderful to be back here addressing you at this forum, and I'd just like to thank the Mining Indaba for again inviting us back. For those of you who are unacquainted with Core Consultants, we are a focused mining consultancy offering bespoke research and consultancy exclusively to the mining industry. Our consultancy takes the form of pre-feasibility and feasibility studies, modeling financial projections, and market entry studies. We also have research which is available on subscription basis and covers information on the latest supply, demands and pricing trends. We have been requested today to speak on the outlook for minor metals in Africa. Minor metals have become synonymous with critical metals. The European Union and the US Department of Defense have outlined those metals which they deem critical. Those metals that are defined as criticals are generally important for our modern way of life and the continuation of our modern way of life, though there is a risk to supply. In some cases, the US and the EU differ as to what they think is critical in terms of supply, but they do agree that the following metals are critical to both regions. These are fluorspar, gallium, germanium, indium, rare earth elements, tantalum and tungsten. Common to all of these commodities are the following key trends. They're normally dominated by a single supplier or country. There is a finite or dwindling resource, as there's been underdevelopment and underinvestment in these resources over recent years. There's generally application in military or defense, which makes it strategic to regions. There is an increasing number of applications in modern devices, in particularly portable devices, and there is limited availability to substitute these materials. All of these create supply constraints and make these metals critical. Each year we tend to focus on market trends of 3 minor metals where the African mining industry may be able to exert a measure of influence. Using the aforementioned list of critical elements, we have identified those 3 metals which are found in significant quantities in Africa and therefore represent potential opportunity for the continent. We will discuss the 3 main drivers of the tantalum, tungsten and dysprosium markets and the factors that deem these critical. I also welcome you to access our website or our YouTube site if you want to download information on past presentations on some of these other metals. In each case, I will share with you our opinion on supply and demand and those factors which could influence these markets going forward. So we begin here with tungsten. Whilst Africa is not the largest producer, nor does it constitute the region with the most number of projects under development, tungsten mining comprises a significant contribution to global supply, and in 2012, 16% of Chinese tungsten imports actually originated from Rwanda. Furthermore, in November last year, Rwanda became the first country in the Great Lakes region to issue a regional mining export certificate in order to ensure that the region complies with the new laws regarding conflict minerals. Therefore, these exports are now going to be more readily accepted by developed countries. Rwanda boasts over 500 mine sites, with tin, coltan and tungsten being the most important minerals traded in Rwanda, and therefore this new regional compliance certificate could once again put Rwanda on the map in terms of supply of these metals. Currently, China constitutes over 50% of tungsten supply, having flooded the market during the 1990s dot-com boom, driving down prices and forcing the closure of Western producers. Moreover, in recent years, demand has outpaced supply, necessitating the sale of stockpiles by governments, including Chinese, Russian, and American governments. Accordingly, the United States stockpile now fell from 35,500 tons to 7,500 tons from the years 2000 to 2011. As the chart indicates, since 2008, prices have improved, though the market continues to rely on China. As with many commodities, China has continued to put in place measures to consolidate and control its domestic production and the supply of it. Mainly these measures include export quotas and export taxes. And this is very clear in the chart that following the financial recession, prices rose from $250 per tonne to $450 per tonne, mainly on the back of restricted exports from China. China now accounts for over half of the world demand and is the fastest growing consumer. The country is therefore going to continue to take measures in order to ensure that its own domestic supply is met. This has placed an unprecedented threat on the rest of the world outside of China, which presents enormous opportunities for the development of tungsten ores, concentrates and intermediary products outside of China. However, resources are becoming depleted within China, and new capacity is merely replacing older mines and deposits where the deposits and resources are becoming depleted. Therefore, the risk that China will once again flood the market as they did during the 1990s is actually minimal. Outside of China, major producers are unwilling and unable to increase production to any major extent. And the largest producer outside of China, which is Katung in Canada, has only 3 years left life of mine based on existing resource figures. With respect to Chinese supply into the rest of the world, since 2006, Chinese consumption has risen faster than its ability to export, and it is evident that if past behavior is a predictor of future behavior, that the outlook for Chinese tungsten supply is actually on a downward trajectory. Based on China's decision to limit its exports to the rest of the world, we estimate that the primary tungsten market is in deficit, and this year we expect this deficit to be in the order of 15,000 tons. Aside from the expectation of a deficit market, there are a number of other factors that are expected to continue to drive demand and prices. These include, firstly, that tungsten is an industrial material and therefore will closely track the GDP growth. Since China is the largest consumer, accounting for over 55% of demand, tungsten demand will closely track the fortunes of China's GDP. China's GDP, according to the IMF, is expected to remain above 7.5% over the next 5 years, and our previous speaker from Macquarie's indicated that it's expected to remain above 6.7%. So the outlook for tungsten is certainly strong. Secondly, with respect to production costs, mines in China are getting deeper, labour costs are expected to increase, as well as the taxes and general inflation is high. All this should drive production costs north and therefore lead to a revision of prices. And lastly, the number of new projects and capacity expansions is less than actually 5% globally. In China, the high capital costs and rising taxes are rendering it difficult to open new mines. And finally, whilst the export quota in China is expected to be reduced, the export costs are expected to increase in order to mitigate government losses. Now, if we look at tantalum, a glimpse at the historic prices of tantalum depicts a commodity that has been subject to a long history of price spikes. This is mainly due to the fact that tantalum is not traded openly and has therefore always been subject to large swings in over and under supply. Mostly tantalum is sold under long-term contracts rather than on the spot market, which has traditionally resulted in preemptive buying. During the 1950s and 1960s, the invention of the tantalum capacitor and its adoption, which was partly driven by the US space program, caused a spike in prices. The 1980s spike was caused by concerns over some mine supply. In 2000, the spike was caused by a surge in demand from mobile devices and the war in the Congo, as well as the fact that during the tech boom, a large number of inventories were stored up, so that on the projection of higher demand for their products, which drove up prices. This was then followed by a tech bubble and then the 2008 economic recession, where each time companies were caught long on material. For this reason, prices do not always reflect the true supply and demand deficit, as consumers have either purchased very long or very short. Looking at tantalum's more recent history, in 2007, the DLA, the US Logistics Agency, ceased sales, which always used to add to the supply availability of tantalum. This was then followed by a price decline owing to the financial crisis in 2008. Then in 2010, the United States proposed the Dodd-Frank law, which is an attempt to stop conflict minerals. This law necessitates that end users show provenance of their raw materials and prove that these raw materials were not extracted from illicit means. Despite the fact that to date only around 40% of the rules regarding the Dodd-Frank law have actually been legislated, and much of the legislation has not actually been implemented, the issues surrounding how global organizations deal with conflict minerals and procure their commodities